Hi everyone, welcome to lesson 2 with Lesson Up Squad. Thank you so much for joining in. Firstly, I'd like to thank all of you guys who's been so responsive to our initiatives in sharing the initiatives, subscribing to our YouTube channel, following us on Instagram. Thank you so much. We've received such a phenomenal response that we've actually decided to extend the program to grade 8, from grade 8 to grade 12. So I hope you guys take advantage of these lessons and hope we can help you in some way. So today I'm going to be starting with a question that I've been receiving on Instagram and on WhatsApp about conceptual learning as to how does it work, why are the slides being used for all the grades, how can one slide explain each grade, and I think it's very important to understand what we're trying to do. So we're creating an environment where we're encouraging learning versus studying. So what that means is when you learn something, you understand the foundation of a concept and you can apply that learning to any question. Versus if you've just studied something for an exam, you're going to study it today, you did it for the sake of the exam, and you're going to forget it tomorrow after writing the exam. And that happens to many of us, right? That's because we don't understand something. We're just studied it for the sake of studying. Here at Lesson Up Squad, we're trying to promote a culture of learning instead. So you're going to learn the logic and you're going to remember that logic. How cool would it be? By the time you reach December, you don't have to actually study anything because you've learned everything. You know it because you understood the logic. So by the time you have your final exams, all you have to do is sit down and practice some questions. And this is what we're encouraging, right? And guys, one more thing, a mindset is a real thing. If you think you can do it and if you think you can't do it, you're right in both situations. So I want you guys to take a step back today and accept it, that you are going to do it. Accounting is going to become something approachable, something you look forward to, something you understand, and you're going to make it happen, right? So let's get to our lesson now. So today's lesson is a request that we received from various people regarding accounting equations. And we did the poll on Instagram, and you could see that most people wanted the lesson to be done on video. So thank you to those that are actually being proactive and suggesting these things because it's helping other people. Keep doing what you're doing, it's good. All right, so back to the lesson. So accounting equation is a rule in accounting, right? So if you remember, as a child, your teacher taught you how to count numbers, and then she taught you how to write the numbers, and then she taught you addition, and then she taught you how to add the numbers. And as much as you use numbers today, you don't go back in and revise every day as to how your teacher taught you to count numbers or to write numbers or to add. That's because you learned it. Once again, highlighting that when you learn something, you don't ever forget it, right? Versus as a child, we didn't have the ability to study. We only had the ability to learn. So we were very open to learning. And this is what we're going to try and encourage ourselves to do, is to learn what we're doing, right? So as a child, you had those numbers, you learned it, you don't really use them. I mean, like, you don't really go revise them every day, but you use them on a daily basis. So the accounting equation is the same rule. You're going to use this accounting equation in every aspect of your accounting questions. If you understand the accounting equation today, you've mastered half of accounting. You've literally mastered half of accounting, and you will not need to worry about spending a lot of time later on. So the trick here is to make sure that you understand it today so that you're going to save a lot of time in the long term, right? And it's just, and I want you to take it as a rule, right? Take it as a rule, understand the rule, and we're going to apply that rule. Next thing, what is the accounting equation? So the accounting equation is the assets equals to equities plus liabilities. I'm very sure many of you have actually seen this, but a lot of you have requested that you still don't understand what it means, and I'm going to help you clarify this. So that is the accounting equation, assets equal to equities plus liabilities. Something very intriguing about this is, have you ever seen your balance sheet, right? And I'm going to show you the format of the balance sheet on the next slide. The format of the balance sheet, on top of the on your balance sheet, you've got your asset, and you've got a value of your total assets. Then you've got at the bottom of your balance sheet, you've got your equities and your liabilities. And that balance will always agree to your asset balance, right? Many of you have heard that your balance sheet is not balancing. What's wrong with it? So many of you know the concept that your balance sheet needs to balance. So that is where the accounting equation comes from. If you ever forget the accounting equation, think of the balance sheet format. It's literally your balance sheet format. You have the assets on top. That's what assets is. Assets are then equal to your equities plus your liabilities, right? And these are the three main categories on your balance sheet: your assets, your equities, and your liabilities. One more thing to remember, and this is something you're going to take away from today's lesson, and that is an accounting equation will always balance. There is no exception to the rule. It cannot happen. If it has happened, you have done something incorrect. It will never happen. An accounting equation will always balance, so please take note of that. So here is the balance sheet format that I was speaking of. If you look very carefully, you'll see here is your total assets, and you'd see your total assets are 26,000, and here you've got your liabilities and your equity, and your total liabilities and equity is also the 26,000. And this is just to show you, in case you forget your formula in an exam and you can't remember whether it was equities plus liabilities or equities minus liabilities or assets plus liabilities, and you're just confused and you've panicked. It's okay. You take a step back and you remind yourself that it looks just like the balance sheet. So if you know your balance sheet, which you will probably know, you will just follow that format and make sure that your equation is now correct. So the $1,000,000 question, what does the accounting equation still tell us, right? Because we've gone through what the accounting equation is, we've gone through how you're going to remember the accounting equation, but some of you may still be unsure as to what it's still trying to tell you. The accounting equation is telling you what you own in the business must equal to what you owe to the third parties, such as creditors, yourself, and other shareholders. That's all it tells you. It tells you something very important. A lot of people miss it and therefore have difficulties understanding accounting equation, but this is all it's telling you. What you own in the business must equal to what you owe to everybody else. So let us talk about the three categories in the accounting equations: the asset, liabilities, and equities. So you now know the equation, but you don't know what defines an asset, what defines a liability, and what defines the equity. So asset is anything that is owned by the entity, and it's anything you can receive money from. Your bank, your inventories, your debtors control. Liabilities are anything you have to pay for. Equities are what I like to call the extra, right? And I'll look at the example below. I say assets equal to liabilities plus equities. That is our accounting equation, right? My assets are 10. I owe people money 8 money I owe people. I'm left with an X. What fills that X? It will be the extra. It will be 2. So it's basically, if I have to sell all my asset, which is worth 10, and I pay off 8, I'll be remaining with 2. Therefore, my assets equal to liability plus equities will always balance. Okay, so some of the examples in the elements in the categories we just defined. Assets can be cash, inventory, account receivable, investment, PPE. You can check each of these. They will go back to the definition of an asset. You can receive money from it. You own it. Liabilities, something you have to pay. Accounts payable you have to pay. Loans you have to pay. SARs you have to pay. Equities, on the other hand, is profit, which is made up of your income minus your expenses, your retained earnings, which is your prior year's profit, drawings, it's money that you take out of your business, and ordinary share capital. Okay, so let's put the balancing theory into test and see if it actually does balance all the time, right? Just say you're opening up a new business, it's a bakery that you want to open up, and you're going to make an initial investment. You've made an investment in the form of cash, so you've got cash 100 Rand, and that is obviously your capital, ordinary share capital, or just call it capital, 100 Rand. Let's go to our equation. Assets equal to liabilities plus equity. On the assets, you'll see you've got 100 Rand, liabilities are 0, and your equities are 100. Your right hand side equals to your left hand side, hence it's balancing. Okay, so now you realize you don't have enough funding and you go to the bank to get a loan from the bank, right? The bank gives you a loan. So you receive money, you receive cash of 50 Rand and you've got a liability of 50 Rand. Now let's look at the accounting equation. Assets equals to liabilities plus equity. You see your assets are 50 Rand, which equals to your liabilities, which are 50 Rand, plus equities, which are 0. Your right-hand side equals to left-hand side. Therefore, we're balancing again. Okay, so now let's look at a third example. This is a very interesting example, right? Because we're actually moving in the same asset category, you can see, right? Just say you needed to buy inventory. So now you're using the cash that you have from the bank and your initial investments to go buy inventory. You've bought inventory worth 30 Rands. You're going to minus 30 Rand cash and you're going to add 30 Rand inventory, right? Does your accounting equation still balance? Let's check. If you look at your assets are 0. The 30 Rand of inventory minus the 30 Rand cash you gave away is 0, liabilities are 0, and equity is 0. Your right-hand side equals to your left-hand side once again. Hence, it is balancing. This proves that your accounting equation at all times will always balance. Alright, some golden rules to remember before we go through some examples. Always identify in the question whether the element you're dealing with, is it asset, liabilities, or equities? So for example, if they speak of cash, is that asset, liabilities, or equities? Always identify that upfront. You can always determine that by the definitions that we've discussed earlier. Always deal with the side you know first. That makes it so much easier for you to know what to do next. Some more good tips for you to remember regarding inventory specifically would be, if you have a return, always remember you have two transactions. If you're losing inventory without receiving full money, that could be due to a damage, due to fire, due to being stolen, there will always be two transactions. If you're selling inventory, there will always be two transactions. Always remember, inventory that is part of a transaction, you always look at the cost price. Debt is part of a transaction, you always look at a selling price. That never changes. Okay, now that we've gone through the basic of accounting equation and we've gone through some tips and tricks, let us look at some examples and see if we can apply them, right? This example was also sent by a student to me. So, issued a credit note of 120 Rand for goods returned. Cost of it was 80 Rand. Firstly, you can already identify that it's two transactions, right? Because it's goods returned. Two transactions mean there will be a debit, a credit, and a debit and another credit, right? So two debits and two credits. Let's identify the elements involved. By elements, I mean what are the line items that are involved in this transaction, right? You've got trading stock. With trading stock, there's cost of sales because you sold the good. Debtor's allowance because the goods have been returned, and debtor's control because the debtor has to return the good to you and you have to reduce his balance. So once you've identified your elements, right, you've got to ask yourself, trading stock, did it go up or did it go down? You received stock. What happened to that stock? It was a plus in your asset. Hence, you've got a plus. Plus assets of 80 Rand, right? And if 80 Rand. Let's talk about the 80 Rand. Why 80 Rand? Remember our golden rule. Inventory always deals with cost price. So, cost of those goods were 80 Rand. Therefore, inventory is plus 80 Rand because you've received that stock, right? Cost of sales, right? Cost of sales on the other side. You know assets are already 80 Rand. So on the other side, you have to do the same thing. You would then plus 80 Rand with owner's equity. Why owner's equity? Cost of sale is not an asset. It doesn't bring us money. It's not something we own. It's not a liability. It's nothing we pay. Therefore, it's owner's equity. It's the extra, right? So therefore, and as a general rule, anything relating to the income statement, you'll see as I go through the example, I have indicated the income statement items with IS in red. Those are your income statement items. That means they will always affect your owner's equity. Therefore, I said initially, always start with what you know. You know you were receiving stock of 80 Rand. You automatically know the other side has to be a plus 80 in owner's equity. debtors allowance or debtors control, right? Debtors control is also minus 120. And that is because that is the selling price of the product. When we deal with the debtors, we deal with the selling price of the product. The debtor, we will reduce the debtor because the debtor no longer owes us money. So it's minus 120. We did 120 on the asset side. We have to put a minus 120 on the other side. Debtors allowance is an income statement item. Hence, it's a minus 120 known as equity. Let's look at another example. Trading stock to the value of 18,000 Rand was damaged due to fire. Insurance paid out 80% of the amount and balance must be treated as a loss. Once again, our inventory golden tip rule. If you've actually lost inventory without receiving full payment, it will be 2 entries. The elements that are involved in this is the trading stock that you've lost, the cash value of the cash that you're going to receive from the insurance, and the trading stock that will be counted as a loss on the asset, right? Let us look at this more in detail, right? So number one, when you receive a question like this when amount is not given, this is a free mark to you. They're telling you if you calculate it correctly, you can get 1 free mark. Literally, for taking 18,000 timesing by 80% on your calculator, you could get a free mark. So that's 14,400. You have lost inventory of 14,400. What is your trading stock? Trading stock is an asset. You're going to go to your asset column, put a minus there, and your value of 14,400 because trading stock will be at cost price. How much did the insurance pay you? 14,400. What did they pay you? Cash. What is cash? Cash is an asset. You go to the asset column, you're receiving money, you put a plus there, 14,400. Trading stock that you've lost, right? Remember, the insurance is paying you 80%. You had a full value of inventory of 18,000 Rand, they're only paying you 14,400. The balance of the stock just got lost. You're still losing some trading stock. That will be minus 3,600. That's on your asset side. A loss on an asset is an income statement item. It will therefore go into your owner's equity column and therefore a minus 3,600. You will see it balances. You've got minus 3,600 on this side, minus 3,600 on the asset side. 14,400 on the asset side, 14,400 on the asset side. Moving on to an easier example. Alpha Bank owes the firm 850. Interest on fixed deposit is capitalized. So what do we mean by the term capitalized? Capitalized means the bank does not physically pay your interest out. They take the interest you've earned and they put it back into your fixed deposit. That is what is meant by capitalized. The elements involved in this transaction is your interest on the bank and your bank. Right? Now, your interest on your bank is an income state item and it will therefore affect your owner's equity. And your bank will also affect, your bank is a cash item and it will affect your assets. If you go to your bank, right? Because bank is the easier one to do. You're receiving 850 Rand more in your bank and therefore under your assets column, you've got a plus 850. You've put a plus 850 on your asset side. You therefore have to put a plus on the other side of the equation. And because it's an income statement item, you put a plus into your owner's equity. Next example, a payment of 11,500 was paid to the bank for the April loan installment. This amount includes interest of 6,500. A payment being made to a bank will always also be 2 transactions because a payment that you make to your bank will always consist of capital and interest. I'm very sure you've heard your parents complain that they pay a certain amount to the bank, but most of it is interest. So anytime you pay anything to the bank, it will always be capital, always be interest, unless the example says otherwise, but it is very unlikely. A bank payment will always include interest and capital portion. So let's look at it. This is another example where you have to calculate an amount. If you calculate an amount, 1 free mark. A payment of 11,500 Rand was made and the amount of interest is 6,500. Therefore, you know that the balance of your capital is 5,000, right? What are the elements involved? You've got your loan that you've repaid, bank because you've repaid from the bank, you've got your interest component, and you've got your bank once again, right? You've identified your components now, right, to the transaction. These components also don't ever change. So your loan was reduced by 5,000 Rand. Your loan can only be reduced by your capital amount. Always remember that. So you know that now you're reducing your loan by 5,000 Rand. Your loan is a liability as we defined it. You're going to be paying it. You go into your liability column, you put 5,000 Rand, and it's a minus because you're reducing your loan, right? If you put 5,000 Rand on that side, on your equity side, on your liability side, you need to put 5,000 Rand on the asset side. Remember which asset reduced? Your bank asset reduced by 5,000 Rand. Therefore, your accounting equation once again is balanced. Your interest on loan. Your interest on loan is the 6,500 that they've given us in this question. The interest on loan will also come off your bank, right? So you're once again reducing your bank balance. Bank is an asset. So you go into your asset column, put minus 6,500 because you're reducing your balance. If you've done that on the asset side, now you go to the other side of the equation, which is your owner's equity, and you minus 6,500 there. Next example, a debtor who owes 1,400 cannot be traced. Write off the debt. Right? So in this example, once again, we identify the elements. The elements are debtor's control and your bad debts. Your bad debts is an income statement item. Therefore, your owner's equity will be affected. Your debtor's control is the balance sheet item. It's an asset. Your asset will be reduced by minus 1,400 and your bad debts on the other side will also be reduced by minus 1,400. Remember, what you do on the right hand side, you need to do on the left hand side. What you do on the left hand side, you must do on the right hand side. So always try and see which side you know. If you know the right hand side, that's fine. You automatically will know what the left hand side will be. Okay, let's look at some more examples that I've received. Allowed customer to open an account, issued an invoice of 2,400, cost price was 1,620. Once again, we're selling inventory. From our inventory golden tip rules, right? One of the rules I said was if you're selling inventory, you'll always have two transactions. Your trading stock and cost of sales, and your sales and your debtors control. Trading stock is an asset. Go to the asset column, you're selling your stock, it will be a minus. Trading stock will always be at cost, just like I had mentioned in the rule. If you did that on the asset side, we need to balance the other side. Therefore, we put minus 1,620 on the owner's equity side because it is an income statement item. Sales. What did we sell? We sold for 2,400. Once again, on the owner's equity side because it affects your income statement. Plus 2,400 needs to be on the other side of the equation, on the left-hand side of the equation. Therefore, you go to your asset column because your debtors control is an asset and you put there 2,400. Next example, the above customer returned a third of goods. A credit note was issued to him. Once again, you were given no amount. Therefore, this is a chance for you to calculate an amount and earn a free mark by literally taking the cost of the inventory and multiplying it by a third. Once again, you'd have four elements to it because goods are being returned. You have your trading stock, you have your cost of sale, you have your debtors allowance, and your debtors control. Your trading stock, right? You're receiving your stock again. You'll take the cost price of 1,620, multiply it by a third to have 540. Once again, trading stock, we will always use the cost price. We are receiving stock back. Trading stock is an asset. You go to your asset column, you plus 540. You did that on this side. You now need to do it on your right-hand side. Owner's equity is plus 540 as well because cost of sales is an income statement item. Anything relating to an income statement item will always affect your owner's equity. Debtors control. You've now obviously same concept. You have to reduce your debtors. Your debtor has given you stock back, so now you've got to reduce their balance. They no longer owe you that money. Debtors always works with selling price. So you take 2,400 and multiply it by a third to get 800. Debtors is an asset. You go to your asset column, you reduce it by 800. You did that on the left hand side, you have to do that on your right hand side. It affects your debtors allowance, which is also an income statement item, and therefore you would minus owner's equity of 800 Rand. Last example, some of the goods previously sold were slightly damaged. The customer once was granted a discount of 20%. Goods sold for 1,000 Rand and the cost price of it was 800 Rand. So how do you deal with this? You're not getting return of stock back, you're just giving them additional discount. What that means is the debtor now owes you less. You can't anymore ask him to pay you the full value. You gave him a 20% discount and they now have to pay you even less than they had, which means you have to adjust your debtor's balance to make sure that when you ask them for the value of money, you're asking them to pay you the correct value. So you'd go to your debtors. Your elements involved would be your debtors and your debtors allowance. Your debtors is an asset, right? You're reducing your asset, therefore it's minus 200. What you do on the left hand side, you need to do on the right hand side. Debtors allowance is an income statement item, and therefore that affects your owner's equity, therefore minus 200. Okay, let us go through the important lesson takeaways today. Always identify in your question the elements firstly, and once you've identified your elements, which is your cash, your inventory, your debtors allowance, after that identify which categories these are in. Are they an asset, are they an equity, or are they a liability? You use the definition to define these elements. Remember, what happens on the right hand side must happen on the left hand side. So if you increased your asset, you need to increase your liability or your owner's equity. The signs must not be the opposite. The signs must always be the same on either side of the right hand side or the left hand side. Always start with what you know. If you're unsure of the second transaction, start with the first transaction. If you have the first transaction, the second transaction is just on the opposite side. Equal, opposite side. Always remember the golden inventory rules. That's all for today's lesson, guys, but remember, we're still here to help. If you still have any questions, drop us a mail. Please subscribe to our YouTube channel so that you know when the latest video comes up. Follow us on Instagram for important news that we're always posting. Feel free to ask questions in the WhatsApp group. Please be proactive. Make use of this initiative. Until next time, bye-bye.